Welcome to the community hotline. For the
There you go.
community, by the community. I am your host, Bob Fang, and today we have Mr. Andrew over here. He is a lender, aka the money guy. Why don't you introduce yourself, Andrew?
Hey, thanks for having me on, Bob. My name is Andrew Soss. I have a company called Benchmark Mortgage. We help people finance home purchases. So to buy a home or an investment property, we help with the financing on that, and we help anybody from brand new first time buyers, never done it, have no idea what APR is or what anything is, and all the way to people that have bought dozens of houses before. So looking forward to chatting with you, and hopefully I can shed some light on this confusing topic.
Got it. So let's get into our first topic. Also, the rules of the game are there is no cursing. So if you do curse, you will get a first strike, a second strike for the second time, and then on the third strike, the community consensus has been that we have to kick you off the community hotline. So just wanted to set the ground rules, but anything else? Let's get into the first topic of the day, which is money. I think there's a lot of confusion around this due to the fact that there's no education about it in schools, and a lot of our parents, they teach us about money, and there's a lot of bad information or whatever information they went. So let me ask you, what is money? How does it work? And and how do you make money?
I think everybody knows what money is. It's an exchange. It's a hold of value, basically, right? Let's say you want an iPod, right? iPod, they don't have iPods anymore. You want an iPhone. I'm aging myself. So you want an iPhone, right? And you want to go to Apple. Well, Apple, what can you provide? You can provide entertainment. You can provide education. Well, Apple may not necessarily be buying that in exchange exactly for your iPhone, right? So what you do is you sell that entertainment and education and what you do for a living. You sell your time to other people. They give you money, and that says that, hey, I did something that was worth something, and whatever it was that I got, that's what it was worth, and then you can use that to purchase other stuff. So if we didn't have money, it would be a lot of bartering. It would be a lot more difficult back in way back when. You can barter because there's only 7 different things that you might need: food, water, shelter. It was a little bit easier to barter. These days, when you have so much different stuff, you have to have some sort of store of money, and luckily for us, we're in a country where the dollar is the world's currency, basically, in terms of what everything else is pegged against. Money is just a way of accounting for the amount of value that you're adding in the system.
Okay, how would you explain that to your 4-year-old?
Yeah. What is money? Money is what daddy goes to work for to get so you can buy toys.
I love that.
And I've tried to explain. I've tried to explain that to her, and I don't think she quite gets it. I think that she just comes, well, just get more money, Dad. Like when we say, hey, sorry, honey, that's too expensive. We can't afford that. Well, just use your card. She just thinks it comes from everywhere, right? So it's funny.
Okay, so it's an exchange of value. Is basically.
Yeah. I mean, at its most fundamental level, money is a store of value, right? So it's you've created value. Somebody's willing to pay you something, give you something for that stores that value. It doesn't just, they don't necessarily have exactly what you want, so that's, you wouldn't want to have to go, if I'm a mortgage broker, right? So I wouldn't want to have to go do a loan every time I wanted a latte, right? For the barista. Right. So I go do loans for other people. They pay me money, and I go use some of that money probably too much of that money to pay the barista.
Yeah. But, was there a moment where your understanding of money changed from when you were in high school to now, or?
Well, I think like conceptually, I never really thought about it when I was growing up. Like, personal finance was never anything that was really meaningfully taught to us. Like, my parents were. I grew up in Orange County, so in City of Orange, yeah. Okay. So, my parents were, very middle class. They worked really hard, but we never had a ton of money, and there was always enough for me to play little league and all that stuff. So we weren't poor by any means, but certainly there was not a whole lot of, hey, this is what you do, this is how you get ahead, this is, you have to save your money here. It was basically hand to mouth. I mean, paycheck to paycheck all the time. They worked hard, so it was able to get there, but there was never any sort of education on, like, you have to put this amount away and everything. It wasn't really until college, I studied economics, statistics and economics, where you started getting into more of the global economy and figuring out like sort of how money moves around, how capital is allocated, how resources are deployed, which is basically what economics studies. And then from there, you get more into how that applies to your personal finance. So it really wasn't until I took a personal finance class that really opened my eyes to a lot of this stuff, and then you dive into all that. But even then, that's 20 years ago. I think 20, yeah, almost 20, going on 20 years now, 18 years ago. I'm still every day learning, and I've been in the industry where I deal with people's personal finances all the time, and every day I'm learning new stuff and new strategies and new ways to behave and figure out different strategies around debt consolidation, paying down, accumulation strategies, stuff like that. So there's always stuff to learn. Nobody ever can really master it.
Okay. Where do you see like the future of money going?
Well, I mean, currency's going away, that's for sure. I think everything's going digital. Well, I mean, I think it won't be anytime super soon, but I think in not too distant future, we'll see more of a cashless society. We're already moving to that. Cash is less and less in circulation in terms of physical cash. It's incredibly expensive to produce. I mean, I don't know if you've heard this stat before, but a penny costs 3.8 cents worth of copper to produce. So not super efficient way of allocating that. Now, in terms of like where it moves in the future, I think that obviously it's moving more electronic, there's also new currencies that are popping up. We can get into a little bit of, I'm not sure if you guys have heard of cryptocurrency, or Bitcoin is probably the most famous one of all of those. I think eventually all of this money in circulation gets replaced by some sort of decentralized currency at some point. So that's an interesting, it's a very controversial topic, but it's I think the direction that it's going.
Oh, I didn't know you were into crypto. You got some money in Bitcoin?
I got like Bitcoin.
You got what Bitcoin?
Maybe one Bitcoin.
Bitcoin. Hey, that's
one Bitcoin.
I like right now.
Enough to taste it. So yeah, but I think that's definitely the direction that it's going, and that has the potential to disrupt quite a bit in the future.
Yeah, no, I'm definitely on the side of crypto and blockchain and everything.
Got it. Yeah.
Before I got into real estate, I was doing a lot of like work for those companies like Ethereum.
Yeah.
And Dogecoin. I don't know if you're invested in that.
Yeah. No, you know a lot more than me. I get down to Ethereum and then I stop. All right.
Got it. Okay, so let's kind of move forward. Let's talk about education then. What would you say is like the and I want to talk about education in terms of like financial education. What are like the biggest hesitations that people have, before of like not wanting to like talk to like a lender?
I think that they might think that it's a bigger commitment than it is. 90% of my job is just education. It's just teaching people with varying levels of experience what the realities are. Because if you're not in it every day, even if you've bought several houses, I've got clients who've I've done dozens of transactions for, and it's just, they rely on me to stay on top of what the rules are and what the, interest rates and the types of programs and all of that. They rely on me to stay on top of that because they're not sitting there studying it every day. And it may have been 2 or 3 years since they did the last transaction. So mainly what I do though is education on what you can do, and then B, more of advice based on what you should do. Based upon my experience of seeing thousands of families' finances, I'd be kind of dumb if I didn't know a thing or two about how to spend money. I think the biggest misnomer that maybe people have is they think it's a lot more complicated than it is. It's actually fairly simple in terms of buying a house, the finances of buying a house. It can get super complicated, but the majority of it, let's say 80% of it, fits within one of 3 topics. So it either has something to do with your credit or your credit score, or what's in your credit report. Has something to do with how much money you have for down payment, and it has something to do with your debt to income ratio. So that's how much you make relative to how much you spend in expenses. So everything that we talked about will be wrapped up into one of those 3 topics. We're either talking about your credit, we're talking about your down payment, or we're talking about your income and liabilities. So there's certain metrics that each of those have to fit within in order to buy a house. Literally in 5 or 10 minutes, I can sometimes tell somebody if they're going to be approved for a house or not, because it could just be super obvious. And then from there, we can move right into from what you can do to what you should do, right? Because you might come to me, Bob, and say like, okay, I make I make this, and here's my income, here's how much I have for down payment, and I might come back and say, okay, great. Well, that means you can qualify for a house that costs $900,000 and your mortgage payment would be $4,000 a month. And you'd say, that's great. You can go pound sand. I only want to spend 2,500. Cool. Well, then we're not going to buy a $900,000 house. We're going to look in the $600,000 range. So from there, you have kind of like what you can do, and then you have what your actual budget is based upon what you want to do or what you feel like you can afford it. And frequently, those are not necessarily the same. So frequently, we will actually qualify you for more than what it is that you're comfortable paying, because we qualify up to 50% of your income in terms of the payments, and that's pretty tight. I don't recommend that, but that's what will be allowed.
Okay. So let's kind of run into I have a deal going on right here. Not a deal, but it's a house. And so basically, I just went on Zillow. Let's pretend I'm a first time home buyer, right?
Great.
And I'm like, oh, like thinking about buying a house.
Yeah.
The wife and I were tired of renting. We need dates. And I'm like, I found this on Zillow. So what does that look like? So
what would you do? Yeah.
So let's say someone calls you up, and they're like,
it says, hey, I found this house on Village Court in Fullerton. I think I want to make an offer on it. Great. Are you pre-approved? No. Okay. Well, let's talk about that first. I don't even care about the house at this point, because this sounds terrible. All you are to me is a number, right? In terms of how much you're approved for. That number is portable. So if I approve you for $700,000, you can go buy this house, or you can go buy one that's $690. I don't really care. I mean, I care that you like the house, but in terms of the loan, as long as it's worth what you're paying for it, which will be determined, we'll get what's called an appraisal. An appraisal is somebody who goes out to the property and as part of doing the loan, goes out to the property, evaluates it, takes pictures, measures it, compares it versus other houses in the neighborhood and what they've sold for, to make sure that what you are buying is supported by the data in the neighborhood. So for instance, if a house down the street that's a very similar home just sold for $525,000, and you get into contract on this one for $568,000, the appraiser is going to go out there and have to reconcile the difference between those two. Now, there might be valid reasons for that. Maybe the one for $525,000 was on a busy street, or maybe the one for $525,000 was slightly smaller or was in worse condition, and this one's remodeled, so that they can make adjustments for what was sold relative to what this one is. So it might still come in at that value. But if it comes in, if you're overpaying for it, you have that appraisal to sort of check you. And you don't necessarily, you can still buy the house, you just end up paying more for it. So there's an appraisal in there. That's what we would base the loan off of. So if you're coming to me, I would start talking about, here's the property. That's great. That at least gives me a price range. I would start talking about your income, your credit, and your down payment.
Okay. So I guess my question is, when you said the appraisal, that happens after you get pre-approved, or when does that happen?
Yeah, because you don't get pre-approved for a house, you get pre-approved for a dollar amount.
Okay. So basically,
getting pre-approved means that you don't know where you're going to buy yet. So typically you'd want to get pre-approved before you go out looking. Otherwise, you might be looking for in a neighborhood that's 700 and you're only approved for 500, or vice versa. Maybe you think you're only going to approve for 500, but you can actually go a little bit higher. So it's important to at least have the initial conversation first, at least just a nuts and bolts. Maybe you don't have to go through the full process before you start looking, but at least talk to a lender so that you can say, hey, I make X amount, I have this amount for down payment, assuming my credit is fine, and this is my car payment, assuming all of this, what would I be qualified for? And that's what's called a pre-qualification. It's great to get information. It doesn't really matter. It doesn't do anything if you actually want to write an offer on a property. In order to write an offer on a property, we have to go to what's called pre-approval, which is taking everything that you told me verbally and validating it based upon pay stubs and bank statements, et cetera.
Got it. So tell me, how does that phone call look? What should people say to sound like they know what they're asking? Like, what would you recommend?
Well, I think the first thing, yeah. So I'm a big fan of authenticity. So the first thing is just say, hey, I'm a first-time buyer. I don't know what the hell I'm doing. So if you do that, the lender will, hopefully a good lender, will talk to you in a way that you can understand it and won't throw a bunch of jargon at you, right? So it sort of, to get the best experience, you don't want to just pretend like you know what you're doing. You want to just say, like, I'm a first-time buyer. I don't really know. I've done this before, so if you can help me walk me through it, I would like to buy this house. I can give you whatever information you need. And the information generally, in my experience, my conversations would go something like, great, where's the house? Awesome. What makes you want to buy there? Talk about that a little bit. Talk about, okay, what do you do for a living? What do you have for down payment? Like, and all of these questions might be super easy, basic, or they might involve opening up some other questions. So if I say, what do you do for a living? You say, I host a community hotline show. Great. All right. Are you W-2 employer? Are you working, or is this your own gig? It's my own gig. Great. Is it a corporation? So you might drill down into some of the stuff within the income, then pop back out and talk now about down payment, talk about credit. So all of those things are sort of baseline of what we're going to be diving into. That conversation, typically, though, most people will know most of the basic answers off the top of their head, or pretty close to it, enough for a good information. We're not going to be saying, great, what is your social security number? What is your exact AGI from last year? All that stuff will be based upon when you send us all the documentation.
Got it. And then I guess, I think a hesitation, that I personally have would just be like, I think there's a lot of mistrust going on with the lenders, especially from like the '08 situation. Of
course.
How would you, what do people have to look out for if a lender's trying to scam them or anything like that? Like, does that happen or?
Yeah, for sure. I would say that it's less about being scammed. Like a lot of that stuff is pretty much gone. Like the out and out, just let me make you sign something I'm gonna own your house or something like that. Like that, those days are pretty much gone, and a lot of those people have left the industry, thank God. But it doesn't mean that all lenders are created equal right now. So I think that you want to, depending on the complexity of your situation, and depending on kind of the amount of handholding you need, it's important to select somebody who's willing to go through that with you and has experience dealing with that. I don't necessarily think that you have to have somebody who's been doing it for 20 years like me, but I think you want to have somebody that at least has been doing it for 5 to 10 years, because there's just, unless you have a super simple scenario, if you're just like a straight W-2 employee and good credit score and you have a strong down payment, no one can really mess that up. It doesn't really matter. Just go to find the place that's got the best rate and call it a day. But if you have anything that's non-standard or anything that you want, like that you're tight on, or you want, you need to have a little bit more experience level on, I would definitely try to avoid somebody who's brand new in it. And you can look up all of this stuff on the licensing. Everybody has to post their, it's called NMLS, the National Mortgage Licensing System, I think. So everybody has that on there, and you can literally see how long they've had their license for.
Got it. Okay. So what's the difference between going to you and quick loans?
Yeah, that's a good question. So there's basically 3 main types of places you can get your loan from. There's like a bank, so like a Wells Fargo, Chase, or like a credit union, like a bank or credit union. You're going to talk to a loan officer who works for, let's just take Chase. You're going to talk to a loan officer who is employed by Chase, has Chase's rates, Chase's guidelines, programs, requirements, fees. And that person at Chase, if B of A has a better deal, is not going to be able to send your loan to B of A, right? They're only going to get paid if they close their loan through Chase. Consequently, if you want to shop that around, you have to go to talk to the guy at Chase, talk to the guy at B of A, talk to the guy at Wells, talk to the girl at the credit union, et cetera. So there's a benefit of going through them, is that you might already have a banking relationship there. You sometimes can get discounts if you already have like a checking account or whatnot, depending on the type of loan that you have that you're going to be getting. You're never really going to get completely ripped off going there, because their rates are kind of set from national levels from the standard. So you're not gonna run into a scenario where they're completely out of the market. They're not usually going to be the lowest rates, but they're typically going to be, if you don't want to shop around, it's very safe to just go to a bank and call it a day. On the opposite side of that is something called a mortgage broker. So a mortgage broker would be an independent loan officer, typically a smaller company, that has relationships with several different, what we call investors. So an investor would be a division of, let's just take Chase again, a division of Chase that they take loan applications in from their broker channel. So their warehouse, or what they call their wholesale channel. Mm-hmm. So we have a broker, they talk to a client, they get the application, they package it up, and they send it off to the wholesale division of Chase. And then Chase would underwrite it and actually fund the loan and then pay the broker a commission. Okay, so that's a mortgage broker model. The benefit of a mortgage broker going there is that they have multiple places they can go. So if Chase has a better rate than Wells Fargo that day, but they've got a better rate than this credit union, they can go to wherever, and they don't care, because they get paid the same wherever they go. So a good broker will retain lots of different relationships, so they can always kind of get the best deal around. The downside of a broker is they lose a little bit of the control of the transaction a little bit, because they're not underwriting and approving and processing the loan. They just kind of package it up and send it off. So you're sort of subject to whatever Chase's underwriting is and their guidelines and their turn times and their service levels. So sometimes, especially when you're buying a house, you can sometimes be late on escrows and stuff. The third type of company is a hybrid between the two, and that's what most mortgage companies are. So you talk about Quicken Loans. My company is called Benchmark Mortgage. So we're similar structured. Like we are called a correspondent lender or a mortgage banker. So it's the same thing as a mortgage broker in that we have multiple different places that we can send our loans to. But instead of sending them there prior to you closing on the house, we actually underwrite and approve and fund your loan all ourselves with our money. And then we sell it to them. We sell them the paper afterwards. And so like if you have a $500,000 loan, we'll make that loan to you for $500,000. Then we'll sell that to, let's say, Chase again. We'll sell that to Chase's correspondent division of the bank. And they'll pay us like $510,000 for it, let's say, and that would be our profit.
And okay, so where do you get the $500,000 from?
Well, it depends on the company. Every company is a little bit different, but 95% of them will be some combination of they put up cash. They put up cash as collateral. Like the owners of the company will put up a lot of cash as collateral, and then they'll get what's called a warehouse line. So warehouse line is like a big giant line of credit, like a big credit card. That we fund your $500,000 loan, then we sell it to Chase. Chase pays us $510,000. We keep the 10 and we pay back the line, and we do that 2,000 times a month.
Okay. Let me just wrap my head around that for a second. So, what's the difference? I guess. So you guys have all that money because you have a big credit card line that's from the warehouse line, and then. Yep. What about like, do you guys ever shop the loan to like private investors?
For the types of loans that I do, no, because the private investor doesn't want a 30-year fixed 3.5% rate of return. So these all of the really good interest rate mortgages, like standard mortgages, private investors are going to be more for like investor deals or something that a normal bank wouldn't do, or something that Wall Street wouldn't just, you can't put it into a pool and they would invest in, which is what most normal mortgages, they get pooled together into one security at like let's say an average rate of 3.5%. And that's a pool of that security. And then that security gets sold to Wall Street. So big institutional investors will invest in the mortgage security piece of that. So that's how the mortgage market works for like standard, conventional, owner-occupied, regular home loans. The private investors, that kind of stuff is more for what they call like non-standard deals, what they call non-QM or non-qualified mortgage deals. Goes through more private stuff. So we do a little bit of that, but 99% of what I do is kind of in the box conventional financing.
Okay, got it. And then I guess just going back to this screen, the Zillow screen, would you ever, like, what happens when you hit this button to get pre-qualified? I mean,
if you hit that button and so Zillow sells these leads, so you're going to cost somebody $50 if you go through all that. Zillow sells these leads to lenders.
Oh.
So we used to do this back when we were first getting started and didn't have a big book of past clients. You can pay Zillow, say, hey, I want to spend $5,000 a month to get leads, and if somebody clicks on this, they go through these, I don't know, it's 10 screens or something like that, and then they take that information and then they sell it to a lender for $50 or something, and then
out of your $5,000 budget, it's kind of like an auction.
Exactly. Yeah. Well, it's not an auction. It's just that you say I will go up to 5,000 this month, and then they'll send you leads. Whatever that would be, like 100. If you go all the way through that, you are going to cost somebody $50 though, and you're going to get a bunch of phone calls.
Okay, so that's what happened.
Yeah.
Got it. Right, I'm not going to do that then. Okay, so I guess for the education part, so people, when they hit, just kind of recap that part, is when they hit you up, they'll call you. The best thing that you say that they should do is basically tell the truth, right? Be like, hey, I'm a first home buyer.
100%. Yeah.
I don't know what I'm doing.
Nothing that you say is gonna mess it up that wouldn't have been found out anyway. So don't worry about like trying to hide anything or anything like that. Just be super straight up honest. Like, this is exactly where we're at. Like, what can we do? And most people are pleasantly surprised that they can actually qualify a little easier than what they thought.
Yeah.
In my experience, I found that most people think it's a lot harder than it actually is.
Got it. And then, but when people call you, some of the things to look out for is that you want someone that's been in the game for at least 5 to 10 years.
Yeah.
Not who just started out.
My recommendation would be that, like, if your buddy's just been doing mortgages for 6 months and you want to throw him a bone, I would, unless you got a super easy deal, I would be a little careful around that, because there are some things that, it's not that this is rocket science, but there are some things that there's a lot to teach, and sometimes you just got to throw people in into the wolves, and it takes 3-4 years to really have enough transactions to where you've sort of seen enough to where 95% of the stuff you can handle. Right now I can handle 99.9% of anything that's thrown at me, because I've just been doing it long enough to I've seen most things. It's very rare that maybe once a week I'll come across something that I haven't seen that before. I'm not sure how we do that. 99% of the questions I can answer off the top of my head, but that's because I've been doing it for 18 years. If you talk to me 10 years ago, maybe I can answer 80% of the questions.
Got it. So for what would you say is like a defining moment for you then? And like what was like a hard deal that you had to go through to where, you learn from that? Like a specific example.
I would say, I don't think necessarily a hard deal. I think that I've learned over time. I think the biggest turning point for me is when I started. Well, I started my company in 2006, and back then there were a lot of people that did both real estate and mortgage. So I had started my company with a partner. I was the mortgage person, he was the real estate person. And so we did both, and that was kind of our model of, hey, we're a one-stop shop. If we'll give you a discount on your loan if you use us for buying the house, because we made a commission off of that. So that was our model. He ended up reconnecting with a high school sweetheart, getting married, and moving we were up in the Bay Area at the time, moving up to like Chico area. So he was going to exit the business night. So I bought him out of the business, but I had to decide whether I just wanted to continue doing mortgages or if I wanted to bring on another partner. And to me, that was it. It was the best move I ever made, was to discontinue the real estate side, focus just on the mortgage side, because my business exploded when I did that. I wasn't so fractured. So in terms of like just entrepreneurship, for any of your listeners who are thinking about starting their own business, to the extent that you can streamline your focus on something that you enjoy, that you're good at, and that makes you money, it has to meet all three of those things. So from a career standpoint, you have to, if you have something that you make a lot of money at, but and you enjoy it, but you're not good at it, then it won't last.
Right.
Your business won't last. If you enjoy it and you enjoy it and you're good at it, but you can't make money at it, it's a hobby. If or if you're really good at it and you make a lot of money at it, but you hate it, you're going to burn out. So you have to choose something that solves for all three of those. And that's what I realized. I never really liked the real estate piece of it. And so when I was able to focus on something that sort of met all three of those goals, and I really streamlined it, and I don't take on every deal now. I stay in my lane, and I focus on what I know we're really, really good at. And I'm happy to refer out the stuff that I can do, I'm licensed to do, but I refer it out to other people because it's not in my wheelhouse. It takes a lot of that mental energy off of the top of your head, and you can really, you can move a lot quicker and deeper into your career and build up a big base of clients quicker.
Got it. All right. Well, then, kind of just to wrap it up, then, what are 3 pieces of life advice you have for the youth?
Okay. So, off the top of my head,
don't
this is fine. I got plenty of this. So, don't get married before 30. Because I think that should be a law. I mean. I really think that should be a law, because I think if that happened, the divorce rate would go down by just miles. Save, like, just pick a percentage. It almost doesn't matter what. Like, pick some percentage that you won't notice out of your paycheck. I don't care how much you make. Let's say your paychecks are $2,000 every 2 weeks. Pick a percentage, 5%. I don't care. That would be $100, and that goes into account that you don't even get statements on. You just throw it in there, don't even look at it. And if you did that, it's amazing how much ahead of the game you would be financially down the road. And I know it's easy, and everybody tells you, like, oh, if you just didn't go to Starbucks, that would add up to $2 million by the time you're 60. Well, when somebody's 22, they don't care so much about when they're 60. When you're 40, you start caring about when you're 60. So the time to start investing is always 5 years ago. like always. So I think that the younger you are, the more advantage you have. Like it makes giant. I mean, just go to like time value of money calculators. It makes giant differences starting even just at a small amount in your early 20s versus waiting until most people wait until they're 30 or 35 to really start putting money away. It puts you behind the 8 ball and it forces you to have to do stuff. And then the third thing, sticking with the financially is to be a little bit more frugal than you think you need to be. Forget about trying to keep up with other people or buying stupid shit that you don't need to buy. Oh, cursing warning. Sorry. Stupid stuff you don't want to buy. Strike one. I can't believe I made it a half an hour. So there's no, as I've gotten older, I've realized that like, it's cool to have a really nice car, but unless you really care about that, like spend your money, like don't be cheap, spend your money on stuff that you really like, not because somebody else likes it.
Got it. So basically the first one is don't get married before you're 30, save money and live frugally.
Yeah.
Got it. Well, when you when you got married?
Which time?
You been married?
Which time? Yeah. The first time I was 27, and then the second time I was 35. Significantly better the second time.
Okay. So that's why you give that advice. Got it.
Well, it actually was my advice that I gave before that. I just didn't follow it.
Now you've been to the fire. Now
anybody could give advice. It takes a strong person to follow it, buddy.
I like that. Okay, guys. Well, thank you guys for watching. Before I forget, 88 Real Estate Media is looking for members to join the oversight committee to build the best mindfulness school in Southern California. Shoot us a message to learn more. And if you do business in the real estate industry, please do consider hiring us next time. Thank you for joining us, Andrew. You got any last words for the audience?
Just, everybody stay safe out there. It's kind of crazy times.
Got it. And then, guys, if you want to hit him up, he's at Soss Lending on Twitter. You want to give us your phone number if anyone wants to hit you?
Or just my website's the easiest. It's just andrewsoss.com. andrewsoss.com.
andrewsoss.com. Cool. All right. Thank you very much.